inside the shocking $11 billion fraud that fooled Wall Street for years. In 2002, WorldCom was a telecommunications giant with dreams of conquering the market. At its peak, the company was valued at $175 billion, boasting a robust growth narrative that mesmerized investors and analysts alike. But just as quickly as it rose, it fell, collapsing into bankruptcy and exposing an $11 billion accounting fraud that shocked the world. The man at the center of this cataclysm? CEO Bernie Ebbers, a charismatic leader whose downfall would serve as a chilling reminder of the dangers lurking behind corporate facades. WorldCom started in 1983 as a small, long-distance telephone company, gradually transforming into the second-largest telecommunications provider in the U.S. by the late 1990s. With aggressive acquisitions, including the purchase of MCI for $37 billion in 1997, the company rapidly expanded its footprint and captured the attention of Wall Street. Investors were dazzled. With revenues soaring, WorldCom's stock surged to nearly $64 per share in 1999. The company became synonymous with success and innovation, earning respect and admiration from industry peers and investors. However, this meteoric rise was soon overshadowed by a shocking reality lurking beneath the surface. Behind the glowing financial reports and optimistic projections, something much darker was brewing. As WorldCom continued to acquire firms and expand operations, it faced mounting competition and increasing pressure to maintain its facade of growth. The stakes were high, and the pressure to deliver results led to increasingly questionable accounting practices that would set the stage for one of the largest corporate frauds in American history. Bernie Ebbers was a larger-than-life figure. Charismatic and authoritative, he led the charge at WorldCom, cultivating a culture of performance and loyalty that inspired his staff. Yet beneath the charm lay a ruthless determination to maintain high stock prices and shareholder confidence at any cost. He and his executive team introduced practices that would soon conceal the reality of WorldCom's financial condition. As revenues began to plateau, WorldCom executives executed a series of unethical accounting maneuvers. The primary deceit involved capitalizing operating expenses as capital expenditures to inflate profits. By misclassifying expenses, they painted a false picture of the company's financial health, artificially boosting earnings and stock prices. By 2000, executives were entering dubious adjustments totaling billions of dollars into the company's financial statements, a tactic that not only misled investors but also exacerbated financial instability. The scheme was simple yet effective. Instead of reporting certain costs in the current period as expenses, these costs were instead treated as investments in the company's future. For example, routine maintenance expenses were moved off the income statement, allowing WorldCom to present a more favorable view of its profitability. This deception extended to revenue reporting as well. For years, executives would falsely inflate revenue figures, cloaking the company's dwindling performance with misleading financial statements. In 2001, WorldCom reported an astounding $1.4 billion in earnings. The truth, however, was starkly different. The executives knew that operating income was insufficient to justify such figures. Frustrated by an unyielding quest for profits, Ebbers and his team resorted to increasingly deceptive tactics to fulfill Wall Street's growing expectations. They even falsified quotes from analysts, sending communications that misled investors regarding WorldCom's growth prospects. What might appear as a bold entrepreneurial spirit was, in reality, the early signs of a frail corporate structure. Employees inside the company were beginning to feel the tension. Whistleblower Cynthia Cooper, who served as WorldCom's head of internal audit, spotted inconsistencies in financial entries. In early 2002, her probing would lead to a deeper investigation into the company's records. Despite warning signs, the manipulations continued, masking the escalating crisis that threatened to ensnare WorldCom. However, as with many deception schemes, the truth could only remain hidden for so long. In mid-2002, the accounting discrepancies became impossible to ignore. The company's financial reports were scrutinized, and investigators soon began probing the labyrinth of misclassifications and falsified entries. The facade began to crumble when it was revealed that WorldCom knowingly inflated its earnings by $11 billion, the largest accounting fraud in U.S. history at that time. Bernie Ebbers, who had once been hailed as a visionary leader, now found himself at the center of a colossal scandal. In March 2002, as the investigations intensified, WorldCom announced a stunning $3.85 billion reduction in previously reported earnings. This was just the tip of the iceberg. It was clear the magnitude of the deceit was staggering. As suspicions mounted and the investigation deepened, many in the financial world were left pondering a shocking question. How did a company once perceived as a titan of industry so thoroughly conceal its crippling failures? As the details of the fraud began to unfold, it became apparent that the mechanisms put in place by Ebbers and his team would lead to severe consequences. Not only for them, but for countless investors and employees who trusted the WorldCom brand. In the following months, as the company spiraled into chaos, the stakes increased dramatically. Facing mounting evidence, the board of directors authorized a sweeping internal audit that sought to uncover the full extent of the fraud. The reports would soon cast a critical spotlight on Ebbers and his executive team. As investigations continued, the various methods employed to mask financial realities would slowly come to light, each revelation leading to more painful truths about a once proud company. The culmination of these events would reveal a heart-wrenching tale of corporate ambition gone awry, a paper trail of misdeeds and difficult choices made by those in power would unravel, and in doing so, expose the underbelly of corporate governance and accountability in a world all too eager to elevate its heroes while overlooking their flaws. Each discovery painted a clearer picture of an organization stuck in a web of lies, desperately attempting to stave off its inevitable collapse. As the world braced for the fallout from WorldCom's unraveling, one thing became abundantly clear. The consequences of unchecked ambition would reverberate for years to come. For the victims, and those who had placed their faith in the financial machinery, this story of deceit would soon become a cautionary tale, a reminder that trust, once broken, is exceedingly difficult to rebuild. The question loomed: how would Ebbers and his inner circle reckon with the truth in the aftermath of their devastating choices? And as the investigation continued, the world would watch closely to understand not just how the fraud occurred, but the deeper implications of the scandal that jolted the foundations of trust within corporate America. In our next story, we'll explore a similar scandal from across the globe that shocked an entire nation, the Satyam Computer Services fraud, which unveiled a billion-dollar deception that would transform India's corporate landscape forever. Join us as we uncover the intricacies of this massive corporate fraud, revealing the human costs behind the numbers. In 2002, WorldCom, once a titan of the telecommunications industry, was ensnared in one of the largest accounting frauds in U.S. history. This scandal sent ripples through Wall Street and laid bare vulnerabilities within regulatory frameworks. At the center of this corporate storm was Scott Sullivan, the chief financial officer of WorldCom. His role was pivotal as he orchestrated a scheme that misrepresented the company's financial status, inflating its assets by nearly $11 billion. This manipulation began to surface as Sullivan allegedly directed employees to capitalize costs that should have been expensed, thereby creating a misleadingly rosy picture of WorldCom's overall financial health. Investigations would later reveal the complexity and audacity of this scheme, but what allowed it to flourish was a toxic corporate culture where dissent was not tolerated. Employees feared for their jobs and often overlooked red flags, amplifying a sense of compliance over integrity. In a startling twist, it was Cynthia Cooper, WorldCom's internal auditor, who ultimately raised concerns that would lead to the unraveling of this elaborate facade. Cooper and her team conducted a raid-like audit in May 2002, uncovering inconsistencies which were too large to ignore. She later described herself as terrified upon discovering the full extent of the deception, but she persistently pushed for accountability. Arthur Andersen, the auditing firm entrusted to review WorldCom's financial statements, played a controversial role in this story. Previously embroiled in the Enron scandal, Andersen was supposed to provide an independent safeguard, Yet it failed to detect the massive discrepancies in WorldCom's reported figures. Critics noted that Anderson's close ties with Sullivan and other executives may have compromised its judgment. Both Enron and WorldCom collapsed in close succession, raising questions about the quality of oversight provided by auditing firms within the burgeoning tech industry. As the scheme unraveled, WorldCom's employees bore the brunt of the fallout. Thousands faced layoffs, and many saw their pensions decimated. Once valued at over $180 billion, the company declared bankruptcy in July 2002, with stock prices plummeting from a high of $64.50 to mere pennies. It was a catastrophic loss that had devastating consequences for employees who had invested their livelihoods in the company's promise. The repercussions were profound. Pension funds lost billions, and employees were left to face an uncertain future. The collapse of WorldCom served as a stark reminder of the fragility within the intersection of corporate ambition and ethical obligation. Federal prosecutors stepped in, launching investigations that would ultimately lead to the indictment of Scott Sullivan and several other key figures. Sullivan resigned on June 25, 2002, just weeks before the company filed for bankruptcy, and was later charged with securities fraud, conspiracy, and insider trading. Prosecutors described his actions as a deliberate effort to mislead investors and inflate WorldCom's stock price. Sullivan's fraudulent machinations, alongside a culture where profits were prioritized at the expense of transparency, created an environment ripe for such a catastrophic collapse. In 2005, Sullivan was convicted on multiple counts related to the fraud and was sentenced to serve 5 years in prison, alongside a lifetime ban from serving as an officer or director of a public company. His downfall, while substantial, raised wider questions about the accountability of corporate leaders and their advisors. The WorldCom scandal revealed not just particular individuals' failings, but an entire system that too often allowed misconduct to go unchecked. The aftermath ignited debates and ultimately led to legislative reforms, including the Sarbanes-Oxley Act of 2002, aimed at improving corporate governance and financial disclosures. As WorldCom's saga unfolded, it became glaringly evident how interconnected the events were to broader themes of corporate resilience and regulatory reform. The company's failure served as a critical lesson for stakeholders, regulators, and the public. It highlighted the essential need for transparent accounting practices and the safeguarding of investors' interests against deceptive corporate maneuvers. Today, the legacy of WorldCom echoes in discussions surrounding corporate ethics, governance, and the necessity of robust oversight mechanisms. Cynicism toward large corporations gained footing, and the tone in boardrooms shifted, a demand for accountability that's not merely institutional, but also personal. With the rise of corporate watchdogs and renewed focus on financial ethics, the WorldCom collapse forged a path toward reform that continues to resonate in the business world today. As we reflect on these developments, it's a reminder that the quest for profit, when disconnected from ethical considerations, can lead to devastating consequences. The WorldCom scandal may have closed its chapter years ago, but the lessons remain ever relevant. The echoes of this corporate crime remind us that vigilance and integrity are the cornerstones upon which sound business practices must be built. Here at Corporate Crime Files, we delve into these stories, paralleling past events with current trends and underlying lessons. Tomorrow, we turn our focus to another cautionary tale: the Satyam Computer Services scandal, hailed as India's biggest corporate fraud. Ensure you tune in, for you won't want to miss how ambition, technology, and deceit can intertwine to alter the course of history forever. We'll see you there. For me, stories like WorldCom remind us that breaches of trust in corporate environments can have far-reaching consequences. Here at Corporate Crime Files, we bring you a new story every single day, exposing the schemes, the scandals, and the people behind them. Tomorrow, we're diving into Satyam Computer Services, India's biggest corporate scandal. You won't want to miss it. I'll see you there. In the world of corporate empires, signs of trouble are often masked by relentless growth and public admiration. But behind the facade at WorldCom, something sinister was brewing. As the telecommunications giant rose to become one of the largest companies in the sector, whispers of concern began to surface. warnings that were either ignored or silenced by the sheer bravado of its leadership. Bernard Ebbers, the co-founder and CEO of WorldCom, was a towering figure, both literally and metaphorically. Standing at over 6 feet tall, he conveyed a sense of authority and confidence that inspired trust among investors, employees, and analysts alike. He presented himself as a visionary, a man of the people who built his company up from humble beginnings with sheer willpower. WorldCom stock, which soared from a modest $1 per share in the late 1990s to over $60 per share in 1999, painted a picture of unstoppable success. Behind these numbers, however, lay a deeply flawed strategy based on aggressive accounting practices and manipulation. The first warning signs began to emerge in 2000 and 2001, right as WorldCom had established itself as a market leader through a series of high-profile acquisitions, including that of MCI Communications. Investors focused on growth and market expansion largely ignored increasing reports of accounting irregularities, but there were significant warning flags that could have presaged the collapse. Analysts and media outlets began questioning the efficacy of WorldCom's reported revenues, especially when compared to competitors. In 2001, short seller David Einhorn publicly challenged WorldCom. During a conference, he raised questions regarding the company's accounting practices and its ability to sustain such high revenue growth. Despite criticism and skepticism from financial analysts, the momentum of the company's stock and Ebbers' charisma enabled the narrative of an infallible WorldCom to endure. This created a dangerous environment where dissenters found themselves marginalized, while champions of uninhibited growth reveled in the expanding financial metrics. But this precarious situation came with deeper psychological undertones. Ebbers, revered as the embodiment of WorldCom's success, began to embody an emperor-has-no-clothes dynamic within the company. Employees and executives faltered in their responsibilities to scrutinize the numbers, granting Ebbers an almost cult-like status. As the pressures mounted to maintain the misleading facade, inadequate management oversight paved the way for egregious accounting practices that would later unravel the company. In the ensuing months, some employees began to voice concerns within organizational formalities, reporting discrepancies and inconsistencies to the corporate compliance department. However, the information was largely disregarded. Procedures for whistleblowing were inadequate, employees feared retaliation, and their concerns went largely unheard in a climate that prioritized breathtaking growth over adherence to ethical standards. The absence of a robust compliance structure allowed fraudulent activities to flourish unchallenged. Investigators would later discover that WorldCom employed a scheme involving its capital expenditure accounting, with management actively misclassifying operating expenses as capital expenditures. This tactic artificially inflated profits by leveraging improper accounting practices that disguised financial discrepancies. The company carried out this through various accounting maneuvers, including the infamous line costs accounting method. What this essentially meant was that WorldCom recorded and consolidated expenses in a way that misrepresented the firm's financial health to investors, analysts, and the board. As well, the company relied heavily on non-GAAP, generally accepted accounting principles, financial metrics instead of traditional GAAP measures to avoid revealing its deteriorating profit margins. By the end of 2001, Ebbers presided over a massive discrepancy. WorldCom reported a staggering $3.8 billion in fraudulent accounting entries. The full scale of these manipulations was staggering, but hidden in the hustle of everyday operations. Then came June 2002, when the walls that held WorldCom's intricate web of deceit began to crumble. Whistleblower Cynthia Cooper, the company's internal audit director, uncovered the massive accounting fraud while investigating the firm's financial records. Cooper's findings revealed systemic fraud and deceptive accounting practices that were beyond anything anyone had anticipated. Her discoveries indicated a shocking series of journal entries that included fake entries about earnings, alongside incredible mischaracterizations of operating expenses. Cooper's findings prompted Senate and SEC investigations that would reveal the larger systemic failures surrounding the company's auditing processes. The evidence proved unstoppable. By July 2002, WorldCom filed for bankruptcy in what was then the largest bankruptcy case in U.S. history, with debts exceeding $41 billion. Following the bankruptcy announcement, the fallout extended across the financial landscape, shaking investor confidence and sparking a nationwide debate over corporate governance and ethics. In consequence, the legal repercussions were dire. Bernard Ebbers was charged with securities fraud, conspiracy, and filing false documents with regulators. The trials painted a picture of a man whose pride and unrelenting ambition overshadowed basic ethical principles. In 2005, Ebbers was ultimately convicted, receiving a 25-year prison sentence. The court ruled that he must be held accountable for his role in perpetuating this massive corporate fraud. WorldCom's collapse led to larger conversations about corporate accountability and ethical practices in corporate governance. In response to the financial meltdown, Congress passed the Sarbanes-Oxley Act in 2002, aiming to enhance corporate governance and accountability in financial practices. This legislation imposed strict regulatory considerations for corporate financial disclosures and auditing methods, effectively attempting to raise the bar for public company accountability. The Sarbanes-Oxley Act also made provisions to penalize executives that engaged in unethical accounting practices or misrepresentation of financial conditions. The consequences of WorldCom's downfall extended well beyond the courtroom. Employees lost their jobs and retirement savings, and thousands of shareholders were left reeling from their investments. The devastation hit hardest for everyday workers who saw their life's work vanish into thin air. While top executives faced charges and sentences, employees grappling with uncertainty bore the brunt of a broken system. For me, stories like WorldCom remind us that even the largest corporations can crumble when integrity is abandoned. Here at Corporate Crime Files, we bring you a new story every single day, exposing the schemes, the scandals, and the people behind them. Tomorrow, we are diving into Satyam Computer Services, India's biggest corporate scandal. You will not want to miss it. I will see you there.